This is our introduction to financial statements and a little bit of an introduction to Excel. I'm going to try to teach two things today, assuming that you haven't read the book or aren't really prepared for the first day of class. I thought I'd try and teach you something. First of all, you should see that I've got a whole bunch of stuff already loaded into the computer or into the spreadsheet. So I'm going to take some shortcuts that you won't be able to. You'd have to type these things in. So I'm going to start out here. I'm going to, with the balance sheet. I'm going to create a balance sheet and talk about what's on the balance sheet as we go through. Then I'll do the income statement. First of all, we're going to use Miller Motor Company for the company name whenever we need. So financial statements all have a title, the company name, which financial statement it is, and you'd have to type it in. Looks like I could have typed it in just as quick, so I'm not saving any time now. Hopefully I will. There we go. And a date. Now the balance sheet is as of a date and time. So that's the company. Financial statements all have to have a heading. It's a little different, but we'll see. Then now you'll notice over here, if you look, I've got some little cheat numbers here. There's more than I can remember, so I cheated. I'm going to enter cash. Now you'd have to type it in, but I don't want to spend all day typing. Investments, accounts. Well, I can't see that. Now one of the things I can do is I can come up here to where these two cells, you see that little double arrow there? I can drag and increase the width of my cells. So that's helpful. Or another thing I can do, see that arrow over there? I can drag that arrow across the cells and say, oh, let's make this column width narrower. So we'll play with that. We'll learn a little bit as we go along. Inventory, supplies, prepaid insurance. And now I'm going to change that to prepaid rent for now. The point I want to make here is assets have future benefits. There's a future benefit to an asset. So what's the benefit of an investment? I can sell it. What's the benefit of a receivable? I'm going to receive. What am I going to receive? I'm going to receive cash. Somebody's going to pay me cash in the future. Inventory, I can sell it. Supplies, paper, pencils, well, I'm not going to have to buy them for a while. Prepaid rent. Now what this is if you rented your apartment 1 month at a time, we'd call that rent expense. If you paid the full year's rent in advance, we'd call that prepaid rent. You prepaid your rent. Investments again. Ooh, well, that's interesting. The short-term investments are things we're going to use in the short term. So if you're saving up money for next quarter's tuition, that would be short-term investment. If you're saving up money for your retirement, that would be long-term. Now we have land, building, equipment. Now equipment can be lots of things. It can be computers, it can be furniture and fixtures, it can be machines, it can be trucks, but on the financial statements we tend to lump them all as equipment. Accumulated depreciation, we don't want to worry about that too much, but I'm going to make my column a little wider here. And then I have patents, goodwill. Those are intangible assets, we call them. Whoa, I didn't mean to do that. There we go. Intangible, so land, building, and equipment, those are things we can touch. Patents, ooh, if I have a patent, drug companies have lots of patents on their medicines. Goodwill, that's something we'll talk about much later. But what I want you to do is get a feel for what assets are, what type of accounts are assets. Now we're going to come over and liabilities. Now, where do we get the money to buy these assets? Land, building, we had to buy that stuff. The supplies, the inventory, we had to buy that stuff. Where did the money come from? So we can raise the money one of two ways. We can borrow it, or we can invest, have our owners invest in it. So I'm going to stretch this out a little further there. I'm going to narrow these two down. Notice the arrow across the two. I'm going to change the column with the 4. There we go. I want a little more space there, so I'm going to put that back to 8. Now notice you can memorize accounts, but I can overdo you. Look at all these accounts. So, you know, these are all accounts that I pre-entered to play this game. So I don't know how many that is, but it's more than I can memorize. You don't want to memorize. Look at these, all end up payable. What's a liability? What's the liability? I've got to give something up in the future. A payable means I'm going to give up cash. So payables are liabilities. Receivables are assets. If we're going to receive something, that's an asset, a future benefit. If it's a payable, it's a future sacrifice. And most, not all, but most liabilities end in the word payable. All payables are liabilities. I don't need to memorize all that. Then I have unearned revenue. That's a liability. Somebody pays me in advance. I owe them something. So this is a magazine subscription. If I subscribe to Business Week for 3 years in advance, for them, for Business Week, that's an unearned revenue. Then I've got, I don't know what I have. I'll have to plug. There we go. I've got notes payable and bonds payable. Again, these are payables. These are short-term, and these are long-term. Okay. So we can borrow money if we want to buy land, building equipment. We can borrow money, or the owners might invest in the company. And they would invest in the company by buying stock in the company. Okay, so this would be an investment by the owners, and this would be borrowed money. So our two sources of money to buy these things, the assets. If we don't buy assets, where do we get the money? We can borrow it, or our owners can invest in it. Then the other thing that we might do is retain earnings. The company can leave the profits in the company. Earnings, profit. We use the words earnings, profit, net income, almost the same. Retained, what the company retained the earnings for reinvestment. So those are some accounts. Then I'm going to do the income statement similarly, and I'm going to narrow down this column, and there we go. And then I've got sales revenue. Let's stretch this out a bit. I've got cost of goods sold. I've got amortization expense, bad debt expense, freight out expense. That's tricky. I'll get sneaky later on with that, but we'll keep it straightforward today. Now, again, I don't want to memorize all this stuff. Look, found in what? The word expense. Whoopee. I don't have to memorize that. If it's an expense, it appears on the income statement. There's 4 kinds of accounts that appear on the income statement. Revenues and expenses are the 2 biggies. Later on, we're also going to have gains and losses. Interest income, interest expense, we account for. We report a little differently, so that's why it's down there. Okay, so my income statement's pretty revenues, expenses. If it's a revenue or an expense, it appears on the income statement. Similarly, gains and losses appear on the income statement. Then I've got my statement of retained earnings. Now, this, I'm just going to make up a number there, 817. And what I want you to see here, I'm going to stretch this out again. So a couple things here. So this is what accounts do. How much did I start out with? Well, I had 997 of them. I increased it by 817. Oh, but I used 517. Dividends are we pay out to the owners. Retained earnings. I had $817 in earnings. Did I retain it all? No, I gave parts of it to the owners. Let's go for, so those are the elements of the financial statements. The balance sheet, I've got assets, liabilities, and stockholders' equity. Those are the 3 pieces, assets, liabilities, and stockholders' equity. Now, assets you have to kind of learn. There's a bunch of them. Liabilities are pretty easy. There's payables and unearned revenue. So most of my liabilities are going to end in payable. Equity, we'll work around that. The income statement is basically revenues minus expenses, plus gains minus losses. So that won't be too hard. And the statement of retained earnings is what I started out with plus net income less what I paid to the owners. Now, before we wrap up for today, I want to look at a couple of things about, so these are the accounts that we're playing with today, a few more, but I want to go down and I want you to see the relationships and think about it so you don't want you memorize it. You'll do plenty of that in the course, one way or the other. So let's look at notes receivable. Now, if somebody owes us money on a note, we're probably going to charge them interest. And so we'll accumulate interest receivable, but on the income statement, that's interest income. So over here's my income statement accounts. And I shouldn't have to do that, right? I can come over here and equal balance sheet. There we go. And this would be equal income statement. So this is my balance sheet. I'm going to make it bold and fancy and big so we can, there we go. These are my balance sheet accounts, my assets, my liabilities, and the stockholders' equity. Okay, so I either borrowed the money, payable, or the owners of the company invested the money. Here's my revenues, my discounts. There's some accounts we haven't seen yet, but don't worry about that. I want you to see, look at the relationship. If somebody owes us money on a note, we'll charge them interest. If there's an interest receivable, there's probably an interest income. Inventory is on the books so we can sell it. When we still own it, we call it inventory. When we sell it, it becomes cost of goods sold. We've got an asset called supplies. When we use that up, we call it supplies expense. We've got prepaid insurance. When we use that up, we call it insurance expense. Okay. Later on, we're going to learn on the balance sheet, we've got depreciation. On the income statement, we call it depreciation expense. One is the yearly expense. The other is accumulated over time. If we've got interest payable, we're probably going to have interest expense. If we've got a note payable, we're going to have interest payable. We've got vacation payable, and that's probably going to go into our wage expense. We've got warranty expense, warranty payable. So hopefully you can see that these relate together. We've got note payable, bond payable. There's going to be interest on the note and the bond, and that's going to create an interest liability and an interest expense. So hopefully I want you to see the relationship to these various accounts rather than try and memorize them all. Okay, well, that's it for now, and I'm going to thank you and hope you have a great day.